Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about something a little bit different. We're going to be talking about real estate investment trusts, aka REITs, aka REITs, right? That's what we're talking about today. Real estate investment trusts, which are tax-wise, they're not a corporation, but we could say that they are for this video. It's just simpler, but they are a trust in reality. But regardless, it's a business that operates and holds real estate, and that's their sole business. And they're publicly traded. The ones that we're talking about today are publicly traded for our convenience. And because they are an REIT, they have to pay 90% of their income of their funds from operating. It's different than a normal company. You have to think of that income or profit versus funds from operation. It's kind of the same, but it's different. Regardless, you have to pay 90% of your income if you're an REIT, if you're the company, to your owners, which is us if we own the shareholders, right? That is good and bad. Good because we make money, we make an income, we get paid dividends, or it's actually called distributions in this case. But it's bad because the company cannot reinvest any further rather than that 10% that they have to keep. But just know that the companies are in good hands. They're not dying. They don't have um, a lack of money to work with. All right. So regardless, the purpose of this video is to look into these REITs and decipher which ones are, undervalued versus overvalued, because it's different than regular stocks. You cannot consider a real estate investment trust is undervalued or overvalued based on the PE ratio. It's based on the funds from the funds from operations. So that's what we are going to be looking at today. In order to do that, we're going to be looking at Seeking Alpha, and we're going to be using that site. But you can see right here, right away, go to 1 year, you can see a lot of dividends. Why is that? Well, Realty Income Corporation, Realty Income Delaware is what they're otherwise called, or ticker symbol O, pays a monthly dividend. So you can see you make 24.8 cents a month, about, let's just call it a quarter. Essentially, you make $3 a year per share, but you get paid a quarter a month. Okay, so that could pay your phone bill if you'd like, $25 a month if you own 100 shares. And the less you invest, the better that yield will be. Right now it's around 4%. You get at 55, you're getting at a better deal than everyone who bought up here. Plus your yield on cost will be less as the price share increases. All right, so let's look at these other companies. We're looking at Seeking Alpha today. Right now, we're looking at Realty Income Corporation. Okay, this is what we are looking at here, the funds from operating. And this is the PE ratio of the real estate investment trust world. So, what do you need to know? Well, this number is basically the PE ratio. Okay, so PE ratio, essentially. So we're looking at this funds from operations, and this is forward looking then into the next year, what the company is estimating they will make next year. So last close price divided by the next fiscal year consensus for funds from operating. It's a valuation metric. They use it to value different companies, whatever, what have you. 15.37. That's the number we are going to keep in our heads. So I'm going to use this here today. I'm going to do ticker symbol O. What yield does it have? It has a 4.8% yield and a 15.37 price per FFO. Okay, because the FFO, you can see right here, is 4. So you just simply take the price divided by the FFO, which is 4, and you get 15.37. So now let's look at peers. This is what the whole purpose of this video is, peers. Now, Realty Income Delaware, they lead this group in market cap. You can see 38 billion compared to the next is 33 billion by Simon Property Group. And just to let you know some background, Realty Income Delaware, they deal with NNN tenants, triple N or triple net, which just simply means the expenses are always passed on into the operator, right? So their common tenant is Walgreens. I believe it's their biggest tenant, which means they buy a parcel of land, they buy a building, a vacant building, or they buy already pre-existing Walgreens. They rent it out to the Walgreens, and the Walgreens covers everything else, right? All they have to do is pay rent to Realty Income, and Walgreens has to, get the driveway, pave the parking lots, spray the weeds, do the roof whenever it's necessary, keep up with painting, all that good stuff. Realty Income sits back, collects the rent checks, okay? And I believe a lot of these are like that. You can see right here, this is triple N as their ticker symbol. I believe that's the same way. Simon Property Group, they work in malls, okay? So my local mall, they are owned by Simon Property Group, and that's how they make their money. So, each company has their little quirks and stuff, so you have to look more into it rather than just the numbers, but that's giving you some background. Okay, so let's look into Simon Property Group. Yes, this stock was hurt quite a bit, down 35% compared to, down, I think it was 8%. But regardless, let's check out their numbers. Okay, so we're looking at SPG. The yield is 7.76. We'll do 7.8, round that up. And the price per FFO is 7.73. Wow, that's a big difference compared to our lovely stock Realty Income over there. Just because their FFO is actually very large, $11. And that's per share. So it's a big deal. Well, you can see exactly right here. Buy Simon Property Group's 11% FFO yield. Oh, sorry, no, I was wrong. I'm sorry. This is yield, and this is per share is the dividend, right? That's a $7 dividend. This is yield. All right, let's look at peers. And the difference might be, just because this is malls and this is Walgreens, CVS, that type of stuff. Kimco. Bring out our notepad here. Down. What was that? Doesn't say. Must have just started trading. Okay. Anyways, Kim, they have a yield of 4.68, 4.7% yield, and their price per FFO is 12. Okay, so that's a little more on par with our friend Realty Income. Next, looking at our peers here. Regency Centers, looking at a 13 or 13.8. Yield of 4.5%. 13.9 price per FFO. Okay. Oh, this. Okay, now let's go back to Realty Income because the peers on that company were a little bit different than what we were going for. All right, National Realtors, National Retail Properties, and this is similar to Realty Income, so we can see exactly which one is the better deal. All right, we're seeing a 5.3% yield. That's nice. And a price FFO of 13. They're down 6.5% this year, right, compared to Realty Income. Lastly, Federal Realty Investment Trust. Okay. Ticker symbol FRT. We have a yield of 4.78 and a price of FFO of 14.61. Okay, now that gives us all what we need. So we can see right here, let's actually pull and we'll get some, lastly was SPG. So you can see they're down quite a bit compared to Kimco Realty. I knew they didn't just start trading. They're down not very much. You can see from 26 to 18 at a low of COVID from $8, and they pay a nice quarterly dividend of 10 cents a share, which for the share price, not too bad. Now it's 22 cents. And they try to raise that every quarter, it seems, or so. Okay, 4.7 yield. Regency Centers. Yeah, they're all looking like the same, essentially because they're all the same business. It's just commercial real estate. So not much difference in the share price, but we'll go two more. Yes, this one hasn't recovered like the rest of them. You can see, geez, look at this. The earnings have been beaten down constantly. So they do go off earnings per share, although it is still kind of flawed. When you do it this small and you don't value the company off it, it's okay. So yeah, they have lost to almost every single projection in the last couple of years. So that is not a company that I want to be invested in, right? If they cannot deliver of what they promise you. Federal Realty Trust, better, right? You can see they had some tough times during COVID, but it's all better now. And they have a nice dividend of $1.07 a share, mainly because their yield or their price is $86, so it's still a 4% yield. All in all, these companies are all kind of the same. They all look the same. They've been hurt lately. SPG might be the one out of the ordinary, hurt a lot. Kimco hasn't barely recovered since 2008 crash. So a lot of these are damaged and a lot of them are still not bad, right? You can see with a good, track performance, it is not a bad thing to invest in these companies. You can't just look at the yield because yield could be deceiving. It could be the worst company in the world financially. It could be borderline bankrupt, but it has a generous yield and you invest in it. That's how you fail. You might want to further screen these, right? If they're malls versus triple net clients or customers or tenants versus, if you're doing with residential real estate, you'd have to take it away from commercial real estate. It's an entirely different thing, that type of stuff. So I hope this video makes some sense. You cannot value a real estate investment trust with the PE ratio. It is the price from funds from operating. Okay, that's how you do it. So I hope this video helps you in some way. Good luck to you in the next week, and thanks for watching.